Now, I want to talk a bit about how we build portfolios. The purpose of today is not really to talk about performance property, but just to give everyone an idea of what we're seeing in the market. We've got a research department that's existed for about 12 years. We started as a research business before we became property investment advisors. We study every capital city, the top 30 regions across Australia, and we think it gives us unique insights into what's happening in the markets and where we can potentially see market movements before others. So when we're sitting down and building portfolios with our clients, we take a long-term view. We sit down with our clients on an annual basis. We review their portfolio. We provide advice on what they should be doing with regards to rents, improving the properties, whether they should be adding a new property. This is very roughly what a horizon could look like for a client. Over a 30-year period, you start in the accumulation phase. That's really where clients are focused on building their asset base. They're as aggressively, with some risk management in place, of course, buying assets until basically they get capped out and they can't borrow any more money. At that stage, they may look to reduce debt on their current home. They may look to upgrade their home. And then once clients achieve their goal of owning their home, that's when we get into the consolidation phase, and that's when we really focus on building the portfolio for the long term. Following that, you've got a conversion stage where typically our clients are offloading some of their residential assets. As they get a bit closer to retirement, the focus then turns to generating income as opposed to capital growth, and we're converting those residential assets to commercial or other income producing assets, so we can use that income to fund our retirement. That's a very basic rundown. I suppose when we're looking at properties, we think properties within our clients' portfolios have two key strategies. We have what we call foundation assets, which are long-term assets. We're buying them, we don't want to ever sell them. These could be blue chip residential assets, they could be high yielding commercial assets. But the purpose of those is to buy the asset, hold long term, have an active management plan on those assets so we can maybe make improvements, extend them, build a granny flat, etc. when it comes to residential. We then have assets, and this is quite a new term for us, we've probably been working on it for the past 3 years, that we classify as trading assets. So we're looking at essentially timing the markets as best as possible. We think our research gives us that insight that we can get into a market as early in the process or as early in the cycle as possible. And we look to exit that market when it's reached its peak, sell it down, reduce debt on non-deductible debt such as your home loan, and then we may either replace it with another trading asset for further debt reduction, or we may replace it with a foundation asset. So trading assets are typically in markets that are very cyclical, which see short, aggressive periods of growth and very long stagnation periods. Perth is the perfect example, and one of the markets we've been heavily invested in, and I'll talk about a bit later. A foundation asset, Melbourne, Sydney, Brisbane, Adelaide, high quality suburbs with a long proven track record of growth. Anyone that is familiar with performance property would be very familiar with our property clocks. Our clients have seen them monthly for a very long time. Essentially, we have a clock where the left-hand side is the growth stage of the market. It typically runs for 6 to 9 years. A market then becomes unaffordable, reaches its peak, and will move typically sideways. We don't actually see many markets decline by a significant amount, but it goes sideways for a period of 4 to 6 years until it becomes affordable again, and that cycle repeats. And that's been happening for as long as we have the data on all these markets. This has been a great tool for us to understand where markets are in their respective cycles. What it has never been able to tell us is how quickly a property or a market can move from the bottom to the top of the cycle. So we've spent a long time. There's some unique IP in this, but we've developed what we call a demand score, which takes into account all the current data we have, such as vacancy rates. It also has forward-looking demand data, such as dwelling constructions, future vacancy rate, employment, income growth, etc. And that essentially allows us to put these markets in that top right-hand segment, which have the longest runway for growth, and we think that growth can happen in a very, very quick period. What that looks like right now for all the markets we're looking at, this is the housing market. Obviously, the holy grail is this top right-hand corner, 75 to 100% potential growth, and that can happen at a very quick velocity because of all those factors I mentioned, and you'll see a bit more about the data, why we think these markets can move really aggressively. And this is the similar thing for the unit market, which arguably there's more value in units nationally than we've ever seen, and I'll touch on that in a moment. From a national point of view, I just want to give everyone a summary of where we were versus where we are now. May 2020, obviously we all remember that very fondly, being from Melbourne. There was a lot of talks that property markets were going to collapse, 30, 50, 60% falls. Obviously, since then, quite the opposite's happened. We've had an incredible run of growth in a lot of markets. Some markets moving over 60%, some markets like our own Melbourne, unfortunately being very flat, but that is a market that perhaps is showing opportunity, which I'll touch on in a little bit. This is the theme nationally, and you might hear about it in the media already. We have a chronic housing shortage. The vacancy rate is very clear. Most markets are sub 1.5%, 2%. A balanced rental market is at 3%, where we don't really see rental increases. 2% is aggressive, 1%, and you're talking double-digit rental growth until that housing crisis is sorted. So that is a national theme. So that's regarding the rental market. When it comes to the housing market, dwelling approvals are basically at an all-time low. This is approval data. We know that with the cost of building, the interest rate environment, approvals to actual constructions are far lower than they've historically been. So we've got less dwellings being approved and even less being built. And to counteract that, we have a population of migration that's going out of control. Obviously, we had a couple of years with no migration. We've more than made up for that in 2022 and 2023. 2024, we're going to see similar numbers, 500,000 people. So this is just going to compound the issue that we don't have enough stock to buy and we don't have enough stock to sell. Now, different markets are going to react very differently to this. Every market essentially is in this housing crisis. However, markets like Sydney, whilst it's chronically undersupplied, face an affordability issue. Now, Sydney, by far the most unaffordable market in Australia, one of the most unaffordable markets in the world that doesn't allow foreign capital. What this measure is, and you'll see this in all the charts that I chat about tonight, affordability index looks at the average income that goes towards the average mortgage. So what this means essentially is 89% of the average income goes towards the average mortgage. That doesn't make sense, of course, that's just not possible, but that's what the price is meaning. Obviously doesn't take into account what we're seeing, a lot of generational wealth is being transferred. People are coming in with much larger deposits than they typically are, but this is based on an 80% mortgage at the current principal and interest rates. 90% of your mortgage, 90% of your income is going towards your mortgage. You can see historically in the 90s, 2008, it tapped out at about high 60%. We thought in 2022 that we saw the top of the Sydney market. Does anyone have property in Sydney? If you do, congrats. It's been a generational run. It is hard to see it slowing down despite these headwinds. But the tailwinds for Sydney are not as strong as they were. We've got stock on market is now increasing. We obviously had very low stock through that period that we saw incredible growth. You're probably hearing it in the media already, Sydney is starting to soften. That's because there's more stock available. Stock is now taking longer to sell, as you can see, back to almost 30 days. But there's still a chronic shortage. Vacancy rate, 1.6%, very low. Rents are going through the roof. What we do know in Sydney, and I don't have this chart for some reason, but internal migration, when Sydney gets unaffordable, people move elsewhere. They can't afford to buy and they can't afford to rent, and we're seeing a lot of migration from Sydney to the other states. Unfortunately not yet to Melbourne, but maybe soon. A lot of these people are going to Queensland, a lot of these people are going to Adelaide, a lot of these people are going even west to Perth. So Sydney is an interesting market. It's really important because it leads every other market in the country. It gives us a really good idea of what the other markets can achieve in their cycle. As an example, historically, Melbourne has always got to 90% of Sydney's median price. When Melbourne tops its cycle, 90% of Sydney. As we can see right now, this is actually a bit old. I think the Sydney median's above 1.5 now, which tells us that historically Melbourne should be able to get to about 1.2 if my numbers are right, which we're obviously not there. So that's just a really important market because we do see Sydney continuing to come off. Sorry, I'm going the wrong way. But on the flip side, anyone that holds property in Sydney should continue to see rental rises because not enough stock's being produced and the vacancy's sub 2%. Now that's Sydney. Now I want to talk about Melbourne, where for the first time in 4 years' time, we haven't been buying in Melbourne. We've been heavily invested in Queensland, South Australia, Western Australia, and the Vic regionals. We're now looking at a market, at Melbourne as a market that potentially shows value. An issue that we do have is we're still somewhat unaffordable. 57% of the average wage goes towards the average mortgage in Melbourne. That's right around her historical peak. So there is an argument that there's not an enormous amount of value. What you can see with the price growth since 2019, we've had negative 1%, 0%, 16%, and then back down to pretty much moving sideways. So very, very flat market since COVID. I think the statistic was 18%. We're the worst performing capital city in Australia. We're now cheaper than Brisbane, cheaper than Adelaide. We will be cheaper than Perth at the velocity that Perth's running, and we're obviously a lot cheaper than Sydney. We've always been the second most expensive city in Australia, behind Sydney, which makes sense because they're the two most populated cities in Australia. After this current run, we're looking at dropping, we're currently 7th, we're currently looking at dropping to around 12th. Well, at the same time that's happening, we're looking to overtake Sydney's population and be the most populated city in Australia. So there's some of the positives that we're seeing. If we talk about houses versus units, this is a really interesting one. Houses have performed pretty abysmally, but units have performed even worse. And now we've got a gap between unit and houses that is bigger than it ever has been, at about 70%. The average unit is worth 70% of the average house. As you can see, it typically sits around that 85%. So we're looking at units in Melbourne as potential investments. We're also looking at houses. What we do have in our favour, stock is a little bit higher, which is good, presents an opportunity as buyers. We're definitely in a buyer's market in a lot of areas in Melbourne, and that stock is taking longer to sell. We saw a graph the other day that really shocked us, that since the data was available, there's never been a year that there's been less rental properties available in Victoria other than this year. So there's about 20 years of data. Every year we've added somewhere between 5,000 to 15,000 rental properties to the market. This year we're looking at 20,000 reduction in rental properties. So it's a huge number. Obviously we're getting a lot of migration as well, less houses on the market, and an already incredibly aggressive vacancy rate. Now we've got some forward-looking data. We think this vacancy rate's going to land at around 1 to 1.1% in 2025. We think it's then going to hover around 0.6 to 0.7% in 2026. We're looking at dwelling approvals, we're looking at potential construction and overlaying that with migration, and there's no way we're going to keep up with the current demand for rental properties. So that's a really positive thing for investors who are in the market or entering the market. We think it's highly, highly probable you're going to get double-digit percentage rental growth for the next 2 to 4 years in Melbourne. And what that typically means is when rents get unaffordable, people move to buy, and we've got a relatively affordable housing market compared to Sydney and almost compared to Brisbane and Adelaide, where their affordability is now getting a bit too high for their locals. So not all doom and gloom in Melbourne. Like I said, we're actively taking a position. We're buying good quality units, good quality houses in Melbourne for the first time in 4 years. We may not be at the bottom. We think it could be 6 months off, but we think the next 2 to 4 years is going to be pretty promising, and we've got a lot to make up from the underperformance, which we think is largely sentiment driven. Obviously, a lot of legislative changes that impact investors, and that's been happening since the past 5 or 6 years, disincentivising investors. But with that rental rise, who knows, we think it could become really attractive. On the flip side, Perth, a lot of people are scared of Perth. I hear Perth is boom bust, Perth's a mining town. I'll just go to the historical price. Perth isn't boom bust. Perth is, and some of these other resource driven towns, they're typically not boom bust. They're boom and stagnate for a very long time, as I said at the start. You can see Perth, let's go to 01 to 08, Perth tripled in a 7-year period, and then essentially it did nothing for the next 12 years, and now we're on that next aggressive growth cycle. Other markets we're in, Rockhampton, Townsville, which I'll talk about, Cairns, Darwin, Gladstone, all these charts look almost identical, and that's because we get to the peak of the cycle, everyone's making heaps of money, builders are coming in, they're building new properties, and then everyone leaves, and then you've got a drastic oversupply, which takes a really long time to be absorbed, and then it happens again. No one's built anything in Perth for 12 years prior to 2020. It became incredibly affordable. I'll take you back to the affordability. If you remember, Sydney is currently at 89%, Melbourne's at 58%. We got into Perth in 2020, affordability was 20%. 20% of your income goes towards the average mortgage. We're talking buying Camberwell equivalent suburbs for $700,000-800,000 in Perth. Perth had, and at that point, Perth had the highest average income across Australia, higher than Sydney, higher than Melbourne. So you have the perfect storm. We don't think it's come to an end yet. It's still relatively affordable. We're at about 43%. If and when rates come off, this will become more affordable. And historically, Perth's been able to get to around a 60% affordability ceiling, which tells us that there's at least 50% more in that cycle at the current affordability levels. Units, again, we historically have never bought units. But as we develop and look at trading assets, and we're more concerned about picking up the cycle than being in an asset forever, units have formed part of the strategy. Good quality inner city units, single level villa units with courtyards. We're very actively buying those, and we're also buying good quality houses. But as you can see here, units are cheaper than they ever have been in comparison to houses. And that's because in every market in Australia, people buy houses first. Houses get unaffordable. What do they then do? They typically go to units. So units always trail houses a little bit, and Perth's no exception. This is different to the other two charts we've seen on the other markets, and this is what tells us that Perth is still incredibly aggressive. We've got a significant amount of less stock than we've ever had historically. That's this black bar here. 13,000 properties on the market. Properties are selling in 9 days. So the market's incredibly hot. This takes into account all the stock, even the most compromised stock. So to have that number at 9 days is the sign of a really aggressive housing market. Overlay that with a rental market that's sub 1%. We've seen double-digit rental growth for the past 5 years. That's going to continue because we're getting interstate migration, and again, we're still not building anything in Perth. All the products we're buying in Perth, they're all below replacement cost. It's a metric that we study across Australia. Why that's really important, if a market is trading below replacement cost, developers aren't going to build new stock because they can't make any money. So these markets, at a minimum, have to run to replacement cost for developers to then invest, start producing stock, and then these issues with undersupply to be solved. And that's a long process. So we don't see that being solved anytime in the next 3 to 4 years in a market like Perth. And Townsville. Townsville is very similar to Perth. I might come across as a bit repetitive, but as I mentioned, these resource-driven towns all follow similar cycles, and the data is very similar. It's really price point. Townsville's a $500,000 to $700,000 price point for a house. Perth, for a good quality house, you're looking at 800 to 1.2 mil. But the data's identical. So it just really depends on your budget as to which market you enter. But we're looking at 19% affordability. Obviously, being a smaller town, it doesn't get up to around 60%, but we still get to affordability levels of around 50%, which gives us a lot of room to grow. Price to income, the average price is 5 times income, Sydney's 14 times, just as comparison. But as you can see, Townsville can obviously get to a lot more than 5 times income. And similar to Perth, we love this chart. It says the exact same thing. There's less stock than there ever has been in Townsville to purchase. It's selling quicker than it ever has, only 14 days, which is incredibly quick for any market, let alone a regional market. And the vacancy rate story, again, is identical. We're looking at 1.7%, incredibly aggressive, double-digit rental growth for the past 4 years. And a market that's still affordable. They're still not building anything because it's below replacement cost. So we think Townsville, Perth still have quite a bit of legs to run, despite the strong growth they've already seen. What are these type of properties? They can really range. Townsville, we're buying good quality family homes. This is a duplex, two bedroom, 1 bathroom unit at the front, the same at the back. Really strong yields, a good quality house, you're looking at 5 to 5.5% growth. Obviously, if you're looking at a duplex, a little bit more. In good quality suburbs that don't have flooding issues, that houses that can withstand the cyclones, if and when they likely come. Melbourne, this is pretty characteristic of the type of properties we're buying in Melbourne. Good quality homes in good areas, inner city Melbourne, AAA suburbs as we call them, which have historic long-term growth above 7%. This is the stuff that we've literally just started buying in the past couple of months because it's showing more value than it ever has. Perth, good quality family homes, inner city suburb, full block of land, 4 bedroom, 2 bathroom home, about 6 Ks from the Perth CBD, $900,000. I don't think there's a capital city that you can get that with anywhere in Australia. So this is still the stuff we're buying here. So that's a residential update. I want to touch on commercial briefly. Myself and my colleague Gus here on the commercial acquisitions department, performance property. We're buying a lot of investments for clients. We're buying a lot of business premises for clients. So I think it's important we all have a bit of an idea what's happening in the market. This is pretty general. I don't want to dig into every market because I don't want to hold everyone for the whole night. But as a general theme in the market, transaction volumes are way down, lower than they've been almost ever. 2022 was a pretty crazy year in terms of volume. You could put up a property and ask whatever you want and it would sell. 2023 was a bit different as rates rose. 2024, we've got a very, very low stock environment. That's purely because yields haven't softened anywhere where investors want them to, essentially. We've seen 400 basis point increase in the cash rate. We've seen yields on good stuff go out by 50 to 100 basis points. Industrial stock, which is a bit of the darling, has gone out by 100 basis points, and there's no margin between your cost of debt and the yield you're getting on a commercial property. Well, historically, that's been 2 or 3%. So a lot of clients move to commercial to be positively geared. It's actually quite difficult to get a really good quality metro property that is positively geared, depending on what price point you're playing in. On the flip side, this is a positive for commercial property, and another reason why values have held up really well. Construction costs, I talked about it before, below replacement costs. it's hardly feasible to develop new stock. If you're buying industrial land and developing new factories, the margins are really, really slim. I don't look at many development sites, but I haven't seen many that actually stack up in the past 24 months. So new stock's not being produced, which is withholding prices of existing stock and in some cases pushing them even higher. And that's led by rental growth, and it's also obviously led by capital growth. So this 2 to 10 mil range, we play in that quite a lot. Our private investors are buying a couple of properties in that range for their portfolio. Incredibly aggressive, dominated by owner-occupiers, investors. If you have a commercial property, particularly industrial, and you want to sell it with a tenant in place, I'd suggest not, and wait until it's vacant, because in every market in Australia that we operate, you're going to get a big premium for selling a vacant warehouse. So that's where yields are. Good quality commercial property. It's a broad term. What we classify as good quality, non-specialised commercial property, you're still struggling to get yields above 5.5%. A $2 million factory in Brisbane would be trading at 5.5% on a good day. That same shed in Melbourne would be trading at 4.5%, 5%, and in Sydney, 4.5%. So yields are still really tight. We think the market should soften a little bit, but rising rents, the lack of stock that's coming to the market should keep prices pretty strong in the short term. What we are buying, what we're still recommending our clients to buy, if you want a principal place of business, you're taking a long-term approach, that's still a good strategy. If you're going to be in a premises for 20 years, it could work. It could make sense to do that right now. Good quality passive stock, 5.5%. We're buying a lot of value add stock, particularly in the industrial space, that has some rental reversion in 12 to 24 months. That'll get you up to above 6% net yields. And we also like some development sites. We don't have clients who are developers. We have clients who may speculate on a development site and want to sell to a developer. But development sites with some income can be a good play if you're understanding what could happen in the unit market, which I spoke about earlier. Not many development sites stack up if you're building residential apartments, but if apartment prices move 10, 15, 20% or more, which the data is pretty strong that could happen, you go to a site that's generating no margin to all of a sudden you can develop it. So they're some of the strategies that we're still helping our clients execute. Some of the properties playing on that unit market being undervalued in Melbourne. This is something we bought recently in Fairfield. Good quality AAA suburb, 8 units in this block, a 4% net yield, needs some cosmetic work, a little bit of love, but we're playing on that uplift in the unit cycle for Melbourne. Our client was looking for a balanced asset, good blend of capital growth and yield. This is just a passive, good quality property in Adelaide, had some development upside, brand new 7-year lease, brand new building or recently refurbished building, almost a 6% net yield. This is typical of what a lot of our investors want. They're passive, hands off, a lot of professionals, a lot of medical professionals. They don't want to get in and develop a site, they just want to hold something and generate some passive income. This is, I mentioned that value add or that rental reversion point when it came to industrial. This is a property in Willawong, good quality industrial suburb in Brisbane. We picked this up for an initial yield of 5%. The existing lease had only 6 months to run. They renewed their option. Their rent was about 40% under market. We pushed it up to market and that client's generating a yield of 7%. There are these opportunities that are still there. Industrial rents have done double digits year on year for the past 3 or 4 years. Some rents are up 100% in that period, and some tenants are coming off leases in the next 12 to 24 months, and you have the ability to increase that to market. So if you can deal with a bit of short-term pain, if you are leveraging that, it's going to hurt for 12 to 24 months, but the upside on the yield and the upside in the capital growth is going to be pretty strong. And another little bit different retail asset, south of Perth, about 20k south of Perth, long-term lease to cash converters, a couple of smaller tenants. Again, this is another one of those set and forget assets. Let's not do anything to it. Hold it long-term, 7.3% net yield. just a good addition to our client who was looking at building around a 20 mil portfolio. This would be one of 4 commercial assets that they put in that portfolio. And to summarise, so interest rates obviously have provided headwinds or produce headwinds for all markets. We have still seen markets grow phenomenally well in this rising rate environment. What they can do when rates come down, we don't know, but it should be very positive for a lot of our investors. Residential and commercial markets, as I mentioned, heavily undersupplied. Rental side, housing side, very limited stock, commercial, residential. We think we're going to get continued strong rental growth in pretty much every market in Australia. We still think there's an opportunity to buy residential growth assets. We're not in Perth forever. We're not in Townsville forever. Once these markets don't show enough value for us, we exit and then we find another market that shows value. I won't go back to the clock, but there's a lot of markets that are at the top of the cycle or will be at the top of the cycle in 24 months. And not a lot of markets that are going to be at the bottom of the cycle. So we think now's a really good time to take advantage of that upswing. And clients, as I mentioned at the start, moving towards retirement, now could be a time to consolidate your assets, shift from growth focus to a net yield focus, and obviously provide some income during retirement. That is everything.
So just quickly, how about a quick round of applause there for Alex? We were asking questions, so I just want to step into the sense of amazing insights there.